The silent partner. What paying off your mortgage actually does to your life. The average American mortgage payment in 2025 was approximately $2,329 per month. Principal and interest only. Add property taxes, insurance, and a basic maintenance reserve, and you are looking at roughly $3,000 gone before a single grocery is purchased. The median American household takes home around $5,400 per month after federal taxes, state taxes, and payroll contributions, which means the median mortgaged household is spending more than 50% of take-home pay on the house before the rest of life begins. Financial planning guidelines flag anything above 28% as a warning sign. Most households are running at nearly double that, and we have quietly agreed this is what responsible adulthood looks like. Here is what the bank will not explain when you are signing the 30-year paperwork. Paying off your mortgage does not immediately make you richer in the way most people imagine. What it does is structurally different, and in some ways more powerful than the net worth calculation. It changes the cognitive overhead of every financial decision you will make for the rest of your life. It changes which jobs you will accept, which risks you can absorb, whether you can afford to be wrong, whether you can afford to leave. Most people spend 30 years focused on the monthly payment. The more important thing happening in parallel, quietly and invisibly, every single month, is what the mortgage is doing to how your brain makes choices. That is the story, and by the end of this, the math is going to feel almost secondary. The silent partner. Every business story involving a founder who finally bought out a passive investor describes the same aftermath. The founder starts doing things differently. Bigger swings, faster decisions, a willingness to pivot when the business actually needs it. That is not coincidence, and it is not purely emotional. The silent partner was not doing anything wrong. He was a legitimate stakeholder, but he had a seat at every meeting and a prior claim on every dollar of revenue. As long as he was there, every major decision passed through an unspoken filter. Will this threaten the partner's share? Your mortgage is the silent partner. For the full length of the loan, it has been a passenger in every financial conversation you have had. Every job negotiation happens with the partner in the room. Every career decision gets filtered through one question. Does this threaten the payment? You want to start something on the side? The primary income had better not dip while the partner still needs paying. You want to take a lower salary for work that actually matters to you. The partner does not care what matters to you. The partner wants the same amount it wanted last month, and the month before that, and the month before that. The silent partner never shows up to work, never solves a single problem, never expresses any interest in what you are building. It takes 30 to 40% of disposable income every single month for 30 years and holds a quiet veto over your life in return. When the mortgage is paid off, the partner is bought out. You own the operation entirely. The decisions available to you the next morning are fundamentally different from the ones available the day before. The math argument deserves a serious answer. Before going further, the investment counter-argument deserves honest treatment, because it is not wrong. If your mortgage rate is below 5%, you are mathematically better off investing extra cash than prepaying principal in most historical scenarios. The logic is sound. A guaranteed return equivalent to your mortgage rate loses to a long-run equity return of roughly 8% in the majority of 30-year windows. Approximately 80% of existing American mortgage holders have rates below 5%. The spreadsheet says, invest the difference. Here is what the spreadsheet cannot account for. It assumes you actually invest the difference. Research on consumer behavior consistently shows that discretionary cash, not pre-committed to a specific payment, gets absorbed into lifestyle spending at a significantly higher rate than people predict for themselves in advance. The mortgage payment was forced savings. Remove it and replace it with an optional monthly decision to invest. And a meaningful percentage of households absorb that freed capital into lifestyle within 18 months, with nothing concrete to show for it. Not because they are irresponsible, because discretionary money is genuinely easy to spend and genuinely easy to justify in the moment. The spreadsheet also assumes you have the psychological durability to watch your portfolio fall 40% in a market correction, while still writing a mandatory housing check every month. History says stay invested, but the person watching significant portfolio value disappear while the mortgage continues is not in a spreadsheet environment. They're in a panic environment. And panic environments produce the single most destructive move in personal finance, selling low, which permanently destroys the compounding that made the invest the difference strategy mathematically correct in the first place. At mortgage rates above 7%, which covers most people who've purchased since 2022, aggressive principal paydown is a guaranteed return that competes favorably with almost anything in the market on a risk-adjusted basis. Between 4.5% and 7%, it is a genuine judgment call that depends on your actual behavior, not your theoretical behavior. Below 4.5%, invest the difference, but build a mechanical system for it. Automatic transfers on payday, not an intention. Intentions are the most expensive financial product in existence. What the mortgage actually costs on a $450,000 loan at 6.5%. You pay approximately $573,000 in interest over the life of the loan. Not principal. Interest alone. More than the entire original value of the property. The total payment schedule over 30 years exceeds $1,023,000. For a $450,000 house, both parties signed that contract. The bank ran the math before you got to the table. The argument for running it yourself before you sign, not after, is not cynical. It is just arithmetic. What the research actually says. A 2019 study published in the Proceedings of the National Academy of Sciences tracked participants before and after complete debt elimination, not reduction, elimination. Clinical anxiety symptoms fell from 78% of participants to 53% after accounts were fully closed, a 25 percentage point reduction in diagnosable anxiety from eliminating debt, not from earning more money, not from investing better, from closing the account. Participants also scored measurably better on cognitive assessments after elimination. The finding that proved most instructive: the number of accounts closed mattered more than the dollar amount of relief. Eliminating a smaller debt entirely produced more measurable psychological benefit than a partial reduction on a larger debt. The brain does not calculate relief in dollars. It calculates it in open accounts, in background processes still running. Think of a computer with 40 browser tabs open. Processing speed degrades, not because any single tab is demanding, but because every open tab requires continuous background resource allocation. Your mortgage has been running in the background of every financial calculation you have made for years. Every career evaluation, every risk assessment, every time you consider doing something different, the background process runs. The silent partner weighs in, and eventually you stop noticing it. The same way you stop hearing the refrigerator hum, until it stops. Research from Northwestern University separately confirmed that carrying high debt-to-asset ratios correlates with measurably higher blood pressure, elevated rates of clinical depression, and worse self-reported health outcomes, even after controlling for income levels. The mortgage is not just a financial obligation, it is a physiological one. Your cardiovascular system has been carrying it alongside your balance sheet for years. Harvard-affiliated researchers studying the cognitive problem requiring sustained attention. You have been making every major financial decision of your adult life, including the calculations about whether to pay down the mortgage or invest the difference from inside this cognitive constraint, running the numbers with a slightly slower processor than the one available to you without it. This is not an indictment of your judgment. It is an observation about the conditions, and the conditions change when the partner is gone. How this changes the retirement timeline. The 4% rule says you need 25 times your annual expenses invested before work becomes optional. What most people applying this framework do not fully absorb. The target number is not fixed. It shrinks when your expenses shrink. And eliminating the mortgage is the single largest expense reduction most American households will ever experience. A household with combined income of $115,000, a current mortgage balance of $220,000 at 4%, and annual expenses of $68,000 carries a financial independence target of approximately $1.7 million. Standard math. Now run the same calculation after the mortgage is eliminated. Annual expenses fall to approximately $44,000. The financial independence target drops from $1.7 million to $1.1 million. No additional income earned, no promotion, no business launched. The only change was reducing what survival costs. The gap too close fell by $600,000. The household reaches financial independence years earlier, not through a complex strategy, but because the finish line was recalculated using the correct numbers. What acceleration actually costs per month on a $450,000 mortgage at 6.5%. Switching from monthly to bi-weekly payments costs nothing in real lifestyle change. You pay half the monthly amount every 2 weeks rather than once a month. This produces 26 half payments per year instead of 24, the mathematical equivalent of one full extra payment annually. Result: approximately 5 to 6 years removed from the loan term and roughly $119,000 in interest eliminated. Adding an extra $500 per month to principal reduces the loan term by approximately 8 years and eliminates an additional $150,000 in interest. An extra $1,000 per month shortens the loan to roughly 17 years total. None of these require dramatic lifestyle sacrifice. They are the difference between buying out the silent partner at 55 versus 63. The decisions, options, and risks available in those 8 years are not a small difference. After the last payment, a man who spent 23 years in corporate project management paid off his house in year 21 of a 30-year mortgage. He was 53 years old. He described the moment as disorienting, not painfully, but genuinely unfamiliar. He said it was like a quiet background sound he had lived with so long, he had stopped registering it as noise. And then, one day, complete silence. For the first couple of months, he kept looking at his bank account, confused by the $2,000 per month that nobody had a prior claim on. Not allocated, not reserved, no partner waiting for its share. He did 2 things. He started declining work projects that did not interest him. His manager, who had never heard this from him in 23 years, had a tense conversation about it. He did not backpedal. He used to backpedal. The math used to require it. The new math did not. The second thing he did was launch a consulting practice he had been thinking about since 2021, but had not pursued because the startup phase involves irregular income. Irregular income with a mandatory $2,000 monthly. Housing payment is a categorically different risk profile than irregular income with no mandatory housing payment. One scenario is uncomfortable. The other is the one that causes people to quit too early and confirm the belief that working for yourself does not work. By the end of 2025, the consulting practice was generating $22,000 annually and growing. His corporate salary remained. He was not wealthy in any dramatic sense, but for the first time in his working life, he was negotiating employment from genuine optionality. The job was building wealth. He was no longer the wall standing between his family and financial instability. Jobs that are optional are the only ones where most people work at their actual level. That is not a soft observation. It changes the output, the numbers behind the trend. Approximately 40% of American owner-occupied homes are currently mortgage-free. 63% of homeowners 65 and older are mortgage-free. Fewer than 28% of working-age homeowners are. The average age of full payoff sits between 58 and 63. The median first-time homebuyer age recently reached 36, up from 29 in the 1990s. A 30-year mortgage signed at 36 does not close until 6. The share of households 65 to 17 carrying mortgage debt has risen from 24 to 41% over 30 years. Median mortgage debt amongst seniors is up approximately 400%. We are dragging housing debt into old age at a scale that has no historical precedent in this country, and we have normalized it, treated it as the expected architecture of a financially responsible life, which it is not. The real cost of a paid-off home. The house is not free when the mortgage closes. Property taxes, homeowners insurance, and maintenance reserves remain. Nationally, a paid-off home costs roughly $838 per month. In ongoing ownership costs closer to $1,200 to $1,300 in high-tax states. When a $2,800 payment disappears, you do not get $2,800 to deploy. You get approximately $2,000 in genuinely freed capital. That $2,000 per month compounded at 8% over 20 years produces approximately $1.17 million. Plan for the real number, not the headline number. 3 levels after the mortgage closes. First, protection. Verify the lien release was properly filed and the deed is in your name. Mortgage servicers occasionally do not handle this automatically, and you find out at the worst possible time, when you rebuild liquid savings to 6 to 12 months of your new, lower expenses. You have been financially constrained for years. Liquidity before ambition. Second, acceleration. Take the former mortgage payment and route it through tax-advantaged accounts in order. Employer match in the 401k. First, a 50 to 100% guaranteed return exists nowhere else in finance. Then, a Roth IRA where gains compound permanently, tax-free. Then the full 401k contribution limit. Then a health savings account, if eligible, the most tax-efficient savings vehicle in the federal code. Then everything remaining into a low-cost index fund in a taxable brokerage. $2,000 per month through this structure at 8%, $146,000 in 5 years, $365,000 in 10, $1.17 million in 20. You contributed $480,000. The market contributed $690,000. The majority of the wealth came from compound interest, not from discipline, not from sacrifice, but from removing the mandatory obligation that was standing in the way. Third, permission. The permission to take the career risk, start the business, decline the situation that is costing more than money. Most people never reach this level because they build a lifestyle at level 2 that requires starting over at level 1. The silent partner leaves and is replaced by a different partner, different name, identical veto. The lifestyle absorbed the freed payment. The process protecting the floor you work to build is the most underrated financial discipline available. Not because it requires extraordinary willpower, because it requires a clear picture of what you're actually protecting and why. What to actually do this week. Calculate your financial independence number, both with and without the mortgage, using your real expenses in both states, not estimates. The gap between those two numbers is almost certainly larger than you have run. It frequently changes the entire retirement timeline you are working to. Know which rate environment you are in and be honest about your actual behavior, not your theoretical behavior. Above 7%, aggressive paydown is a guaranteed risk-adjusted return that the market rarely beats cleanly. Between 4.5% and 7%, model your real probability of investing versus spending the freed cash honestly. Below 4.5%, invest the difference, but automate it on payday so it never sits in checking with the question open. On the day the final payment processes, treat the freed amount exactly like a paycheck. Automate it to its destination before the first month of freedom ends. The window between closing the mortgage and establishing the new automated habit is where most people lose the most financially significant moment of their adult lives. Not through bad decisions, through no decision. The money drifts. The tab closes but the relief gets absorbed. The silent partner has been in the room for most of your financial life, quietly collecting, quietly vetoing, present at every negotiation, every career conversation, every time you almost did the thing you actually wanted to do. The path to buying it out is not glamorous. It involves extra payments during years when you would rather do something else with the money. It involves protecting freed capital when everything in consumer culture is engineered to absorb it. It involves treating the finish line as a floor to build from rather than a destination to rest on. But the people who get there report the same thing, consistently, without exception. Not that they feel wealthy. Not that the number is finally large enough. They report that they can make decisions based on what they actually want, rather than what the partner requires. The grip releases. The background process stops. The hum disappears. And in the silence, for the first time in 30 years, you can finally hear yourself think. That is the return no financial product can sell. Because it does not generate a fee. And it does not create demand for anything at all.